Hi, my name's Tom Clendon, your SBR online lecturer, and this episode of the podcast is about depreciation. IAS 16, property, plant and equipment, revaluation. Well, let's start at the beginning. What is depreciation? Depreciation is the systematic allocation of the cost of a non-current asset, normally an item of PPE, where you systematically write it off over its useful life. Now, to that extent, it's a direct application of the matching concept, the accruals concept. Because if you buy an asset, if you buy an item of plant machinery for $5,000 and you think it's going to have a life of 5 years, and at the end of that 5 years you throw it away, it has no value, that asset is being systematically consumed over 5 years. It's giving you a benefit over 5 years. So we capitalize the cost and we systematically write off the cost 1,000, 1,000, 1,000 as an expense through the income statement. So after 1 year, the net book value will be 4, 5 minus 1. After 2 years, the net book value will be 3, 5 minus 2. So the net book value is the amount of the cost you've yet to allocate. Doesn't really represent what it's worth. So depreciation is a non-cash expense. Debit P&L, debit the expense, reduce profit, credit the asset, credit provision for depreciation. So no money changes hands with depreciation. There's a number of different ways that you can estimate the depreciation charge. We can do the straight line method, which I've been inferring in my simple example, where you allocate the costs of the asset equally, or there's the reducing balance method. Straight line is normally a percentage on cost, and the annual charge for the reducing balance method is the percentage on the cost less any depreciation so far provided. Sometimes companies switch between the two. The straight line, move it to reducing balance, or vice versa. And if they do that, that's technically a change in an accounting estimate. It's not a change of policy, but a change in an accounting estimate. And what IAS 8 says is that is normal, and that is to be dealt with on a prospective basis. So you don't go back and restate any prior years. So basically PPE, property, plant and equipment, assets that have been acquired for use in the business, that have a life of more than 1 year, these assets are always going to be subject to depreciation, except land. And the reason we don't depreciate land is nothing to do with its value, it's to do with its life. Because land has an infinite life. And for that reason, we can't systematically allocate the cost of it over its useful life, because its useful life is indefinite. So even if an asset goes up in value, we would still need to depreciate it if it had a limited life. Now there is a choice, there is an accounting policy choice to revalue assets under IAS 16, property, plant and equipment. And if we do that, the basic rule is that we're going to take those gains and losses directly to reserves, directly to equity. We're going to include them in other comprehensive income rather than include them as part of profit. But that's a little bit of a simplistic overview to say gains and losses on PPE go to reserves. They do in the main. Now I'm going to do some numbers here, and you can rewind and listen to this again, or you can use pen and paper if you want to. But let's take an asset, a very simple asset, something like land, so we haven't got the complication with depreciation. And if we have some land which costs 10, then we revalue it to 15, we've got a gain of 5, and that gain of 5 goes to reserves, goes to other comprehensive income. Yeah, nice and simple. Now, if later on That same land is now worth 13, so it's revalued to 13. It was 15, now revalued to 13. That's a loss of 2. And that loss of 2 also goes to reserves, also goes to other comprehensive income. And so the balance on our equity, the balance on our reserve that relates to this particular asset is now only 3. Got it? Happy? So gains and losses are going to reserves. But what if a third transaction, a third valuation comes along and we now say the value of this same land a few years later is 8? Now remember, it was previously revalued at 13 and now we're saying it's worth 8. So that's a fall in value of 5. That's a loss of 5. That's a credit to the asset of 5. We've got to revalue the asset down to 8. How much of that goes to reserves? Well, the balance on your reserves is only 3. So you would take of the 5, you would hit the reserves until they're exhausted, and then the other 2 you would be charging to income statement. Okay? So once you've exhausted once you take the loss to reserves, but you've exhausted that reserve, any further loss is charged to the income statement. But what happens if, and I'm carrying on with the same example, that asset which was at 8 a few years later is now worth 11? And if it's worth 11 now, there's a gain of 3. We're going to be debiting the asset by 3 to bring it up from 8 to 11. Where's the credit going to go? Well, because we had previously charged a loss in income of 2, because we'd previously hit the P&L with 2, we can take the gain, which represents the reversal of previously recognized loss, we can take that to reserves, and then we can take that to the income statement, I should say, and then the balance of 1 will be going to reserves. So you've revalued the asset to 11. Remember, it originally cost 10, and therefore you've got a balance of 1 now sitting in reserves. Wow. Yeah, I hope that helps. I'm going to recap. If we've got a gain or loss on PPE, it will go to reserves. That's the simplistic rule. The detailed rule of that is if we've got a gain, it will go to the reserves, unless it represents the reversal of a loss previously recognized in income. And if we've got a loss, that will also go to the reserves, unless it's exhausted the reserve, in which case, once you've exhausted the reserve, the further losses go to the income statement. Now, remember that revaluation is optional. But if a company does pursue that policy, then all assets in the same class must be revalued. So you can revalue all your land and buildings, but that doesn't mean to say you have to revalue your photocopiers or your motor vehicles. But if you were so stupid enough to revalue a photocopier, then you'd have to revalue all of your photocopiers. But I mean, that's just not going to happen, is it? You also have to keep your valuations up to date. And you also have to charge depreciation on the revalued amount. Now, I want to think about the consequences of revaluation, how it relates to the stakeholder, the user, and how it might relate to the framework. A company that revalues its PPE is going to have more assets, a more carrying value for their assets. So their reported gearing is going to go down. So revaluing assets upwards strengthens the balance sheet. And so if you're comparing yourself with other companies, you're going to look stronger and bigger. You're going to look like you have more assets if you've revalued it. So that's perhaps a good thing. A bad thing, though, is depreciation and profit. Because you're now going to be basing depreciation on the revalued amount, on the higher amount, that means you've got more of an expense and less of profit. So your earnings per share becomes slightly smaller. Your your reported profits become slightly smaller. So it's not 100% clear cut. If you're cynical and you want to say, I want to choose the policy that makes me look best, because there are consequences to revaluing PPE. And if we think about it from a conceptual framework point of view, where we want information to be useful, it's also not 100% clear cut whether we should revalue or we shouldn't. Those in favour of revaluing tend to suggest that by revaluing, you're making the information more relevant. Relevant is predictive of future cash flows. So by having the most up-to-date valuation, the market value, what you could sell the asset for, you're conveying information in that way. You're being predictive, you're being relevant. Others argue that sometimes you've got assets which are never going to be sold. So why would you revalue a machine? Why would you revalue an asset if you've got no intention of selling it? And then other people argue that to be useful, you've got to have faithful representation. And so you've got to be able to reliably measure the asset. And maybe that's where we get a little bit of guidance with IFRS 13. Fair value measurement, level 1, level 2, level 3. But look, I digress. I try and keep these podcasts to, 10 minutes, no more than 15 minutes if possible. So I'm going to call it quits there. But I have seen a discussion, I have seen knowledge relating to ISA 16 coming up in the SBR exam. And it's interesting how we can relate it back to useful information and back to stakeholders. Thank you very much for listening.